Should I buy stock right now or sell the existing one that I have? This is a question I've been receiving in the past 3 or 4 days from people who have been following my recommendations. So I decided to do this video so that you would know how to approach the market at this time. Now, the central banks of different countries right now are faced with two risks. First is the risk of inflation driven by supply chain. We've had to battle with COVID in 2020, and that affected the supply chain, global supply chain, because of shutdown. And then as demand picks up, there was no immediate um, um, let me say opening of most economic activities. So that affected um, the availability of most of the products that we consume. So which is actually the reason a lot of um, countries right now are battling with inflation, having to do with rising demand but no available supply to meet up to that. And you will see that play out in the oil market in the past um, 6 to 12 months. So right now, the central banks of different countries are now asking, should we increase interest rates to help curb this rising inflation, and or to allow it to run? And the effect of a rising inflation. So, and that's also affecting the markets because as investors anticipate increase in interest rates, which is bearish for stock in the long term. So it's normal for institutional investors to start moving funds from risky assets to fixed income just to safeguard their portfolio. So, and that had affected the US market and even the crypto market. So, and what happened when um, institutional investors are moving funds from risky assets to risk-free assets? Maybe they are parking funds in 10-year treasury bills. What happened? Yield begins to dip. So the relationship between yield on treasury notes and also the stock market is direct, because a higher yield equals to a higher um it means that people are moving funds to the US market, and a lower yield equals to a lower um, index. So let me explain that. Now, there's a difference, is an inverse relationship between the price of a bond and also the yield. So as investors buy more of treasury yield, price increases, and when price increases, the yield will reduce. Then, when they sell 10-year treasury notes, what happens? The price reduce, price will go down, and when price goes down, automatically yield goes up. So, and what that means is that as they are taking away their funds from the treasury yield market or fixed income market into stock, yield begins to increase. Now, as they pack that money into stock price will also start increasing. So whenever you see yield go down, that tells you that investors are moving money into fixed income securities. Maybe they are anticipating an economic risk and they need to hedge their portfolio. They need to preserve their capital. Sometimes cash is also the king. So they're just looking for safety. Now, the other way around is that when you see yield going up, meaning that they are selling treasury notes, it means they are moving their money away from fixed income markets into the risky markets. Then it means that they are buying more stock. And at that point, you begin to see it go higher. So you can look at this, you can simulate this charts and then look at what happened in the stock market. You will notice how that had played out. You can see that at the peak of the COVID, you notice how yield died. You can see here, and then between March and um, April, you see how yield has rallied higher. Now, remember, I said that a higher yield means they are moving money away from fixed income markets into the stock market. That's between March and March 2020 and March 2021. So let's look at the SPS um, in that same period too. You can see right here, this is March. This is where we had the can see the way this is where we had the pullback, the dip at the peak, and then you can see how the market rallied higher. So treasury notes, the yield on treasury notes and the stock market tends to have a direct relationship, and I've explained that. Now, as you can see here, let me show you one headline. Charting global economy, central banks intensify inflation fights. So that's what is happening globally. Inflation has risen around the world, but the US has seen one of the biggest increase. So there is this threat of inflation that is actually um, facing all central banks right now, including Nigeria. Even right here in Nigeria, you see how everybody is complaining. Things are expensive, from food prices, almost everything has actually gone up in the last 1 year, and the CBN too is faced with that threat. So the question is, are we going to are we going to see increase in inflation right here in Nigeria? But that's not the topic of discussion for now. So we're looking at the US market. Should I buy stock right now or sell? Because as the market dips, question is, should I sell to preserve my portfolio or buy more, hoping that the market will bounce back since stocks are trading at a huge discount? So that's the question I want to answer right now. So this is the chart of 10-year yield. So you see how the yield had been pulling back. You can see here, you can see this explains the dip we've had in the stock market recently, because investors have been moving money into the fixed income market. And you see how the yield has an established support around this region, which is 1.36. And then you see here with this region, you see this same region right here, how the yield. And then in the current week that we are, the 10-year yield is already up by 6.07% to 1.48%. It opened at 1.38 and then it closed at 1.48. Remember, I said a higher yield equals means that investors are moving funds away from the market. So when yield rises, it means they are selling off their risky assets to buy into stock. So the question you now ask is, why are investors moving funds away from the risky market into risk securities like stock when we anticipate higher inflation and all that? So the answer might be, sometimes this risk might have been priced in the dip already. So, but I'm still watching the market to see how it plays out. So if we drill this down to the daily chart, notice how we have an established support around this region. You can see how the market has bounced back. So what I think would likely happen is that the market may find support at this region, which was previous resistance. You can see here, 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 this side. Look at it here. Now you can see how the market dipped to that same region and then it's bouncing back. So this is a major support. Any attempt for the 10-year yield to close below 1.34, 1.36, then we're looking at a deeper dive to 1.19, and that is not going to be good for stock. So that means that there is an aggressive purchase of risk-free assets. There's an aggressive purchase of 10-year treasury. Now, why do you invest in treasury? Let's come back to Nigeria. You invest in treasury if you want to preserve your capital. So this is a market that is designed for risk-free investors, people that risk-averse investors, people that are looking for um, capital preservation, and still want to earn little interest. So the most important thing here is capital preservation. They do not want to lose. So if investors are moving funds into 10-year treasury, it means that they are anticipating something. They are looking at the stock market going down and they want to preserve their capital. So that's why they have to move funds into this market. So the most important key level that I'm watching right here is this level, and if the market dips below this level, then we're going to see a deeper dive in the stock market. So, but let's look at what has happened in the stock market over time. So we don't just jump in like others and say, whoa, the market is going down, let me quickly sell. You don't take decision like that. You need to be ahead of the market. You need to be ahead of other investors. So that's how to trade the market. So let's look at the um, SPS. Now, before we look at the SPS too, I also want to show you something again. Now, as investors anticipate higher interest rates, you would see that that's going to drive the dollar index, because a higher rate is bullish for the currency of an economy. So you see how the dollar index has rallied. So right now, the dollar index is selling at a critical region. So from 2016 down to 2022, we've had a downtrend. You can see the trend line connecting different high. You can see right here how the market found support resistance at this trend line, and then so you can see that the index is yet to break the trend line, and at this point we might be anticipating a pullback because this index had rallied higher. So we might anticipate a pullback down to this point, and then a little trend, a little rally, then it could go down, or but if it clears this part, then we're looking at a higher run to this point, which is 100. So we might see dollar index are touching the 100 mark very soon, and that is going to be bearish for stock, because if you see dollar index higher, the dollar index higher, it means that investors are parking their money in the US dollar. It means dollar is gaining against major currency, and I've talked about how this would not be good for our local currency. But right now the index is trading around the trend line, which means we might see a little pullback in this market. And if dollar index pull back, that is going to be bullish for stock and even cryptocurrency market. So I think that's even one of the reasons the crypto market has been bouncing back or recovering lately, because we're anticipating a brief pullback on dollar index. So let's look at the SPS so that we can answer the question that you've been asking, whether you should buy stock or not. Now, this is a chart of SPS. Now, the chart of SPS tells you something, even without saying anything. You will see how the SPS has rallied strongly. We've had a strong uptrend, and the market tends to bounce back in either the 50 days or the 100 days moving average. You can see here. So let's look at someone that is breathing in and out. So you have breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. So you can see we've had so these are normal pullback, and then we have a deeper pullback to the 100 days, just like we've had here, and then breathe out. You can see pullback and pullback. So the pullback we see are normal pullback right here. Now, although the one we've had recently with the double top formation here, it's like investors being cautious. But I'm not selling any of my stock right now. Why? Because the market is still in a strong uptrend. The 50 days is still above the 100 days. The 100 days is still above the 150. And that is the sign of a strong uptrend. And if I add another average called the 200 days moving average, to show you how the market has been. I just want to make the line a little bit thicker. So I should have seen the line that is very strong and below this 150. So let's try that again. So we know what we've added so far. Let's take it out. Okay, so if you can see how the averages are lined up strongly, the 50 above. So if the 50 is still above the 100 and the 100 is above the 150, so why am I panicking? You can see here the 50 is still trending strongly. You can see here. So, and as the market pulls back, just like we've had in the past. And all this pullback that we see here are also driven by economic news. So we've had a pullback in the past and it's not a new thing. So I don't panic in the stock market like that. Rather, I look for opportunity to buy. So what's happening right now? Notice how the market pulled back to this 100 days, which also coincide as you can see here, which was previous resistance here and then now turning support. And then you can see how the market found double top. Although this double top is a bearish sign, and then the market is also pulling back. So yesterday the market closed higher by 1.7%. So meaning that people are actually buying stock. And you can see how that also coincides with the 10-year treasury that I mentioned earlier. See here, I said if 10-year treasury closed higher, it means investors are moving money away from the fixed income market into risk market like stock. And then that also played out right here. So as the index sits strongly above, you can see here, as the index sits strongly above the averages, there is no need for panic. There is no cause for panic right now. The market is still in a strong bull run. It's very important. So that's why I always advise at some point when your portfolio is up by at least 20% or more, take profit so that you can take advantage of brief dip like this. So this is it here. So you can see we've had a deeper crash, but the 50 days still strongly above the 100 days. And what happened? The market bounced back. We had a double top. The market dipped again to this same moving average. And then you see how it has rallied. This was in 2020. You can see how it has rallied strongly. So we are in a section or in a region where we would likely find a market bounce at this point because there seems to be overreaction around this Omicron and inflation fears, rate hike and all that. Yes, rate hike is going to pull down stock markets in the short term, which is normal because the cost of borrowing will increase, which will eat into finance costs for some companies. But the kind of stock you should be buying right now are companies that have huge pricing power. Companies that are profitable. Number one, the company has to be profitable. Number one. Number two, it has to be cash flow positive. Number two. Number three, low debt. Because this period will not be good for companies that are exposed to debt. So meaning that the debt exposure should have to be has to be very low. And then the interest cover at least two, meaning that they're able to generate more revenue to pay up existing interest obligations. And for a company to generate more revenue to pay up that existing interest obligation, it also means that they have to generate more money. And how do you generate more money? By increasing the price of your product. And that is where the inflation is positive for certain companies. So if a company has the pricing power to cover up increasing cost, then we should be looking at higher margin in the long run. So that's why when you're buying into certain stocks, you need to also study them and be sure that the product they sell is inelastic. So, example of a stock that I'm mopping up right now is Microsoft. You can see how Microsoft has sit strongly above these averages. So even when we have a bounce, a dip, the market will always bounce back. You can see the stock. You can see, and right now we are actually close to a region where we could also see another bounce. And even if it pulls back further, my strong support on Microsoft stock is around this region. You can see here, we should coincide with the 100 days moving average. So, a worst case scenario, Microsoft pullback with this because Microsoft is one of the companies that has high pricing power. Microsoft can increase the price of the subscription and it will have little or no effect on its products because most of its products are considered tech essential products. You can't stop using Windows because you don't like Microsoft products. Majority of people, PC users are on Windows. You can't stop using a lot of there are so many Microsoft products out there that and they are still churning out more products. So that's example of one stock that has higher pricing power. And there's so much um in the market right now. So when market dips like this, you should be taking advantage of fundamentally sound stock. my definition of fundamentally sound stocks are stocks with consistent growth in that have achieved consistent growth in revenue, profit, cash flow, lower debt, and are considered undervalued. That's very important. They are considered undervalued, meaning that the price is actually above below the fair value. So you can quickly snap them at the lower end of the market. So the big guys, the profitable investor in the stock market are those that are able to buy up stock at a cheap price at the peak of a dip and then sell them at a higher price. So if you should be buying stock right now, what you should be doing at this stage now is to pick only fundamentally sound stock that are grossly undervalued and also trading at their major support region. So that's what you should be doing at this stage in the stock market. And I've shared why the stock market is still in a strong bull run. Majority of the all the averages, in short, all the key averages are still line up sequentially, the 50 above the 100, the 100 above the 150. So there is no cause for panic at this stage until we see a bearish cross where the 50 cross the 100 to the downside. Then we might say, oh, we are in for a deeper pullback. So right now the market is still in a very strong uptrend. So you do not have any cause to panic because we've had similar pullback in the past.